So let's look at inflation. How is inflation treated in just to tell you, inflation is either general inflation. First, we all know what inflation is. In the record now, inflation is general rise in prices. But let me just tell you, nobody will ask you what is inflation in FM. So you see general rise in the prices or in price level. So that's inflation. As far as FM or financial management is concerned, inflation is seen from two perspectives. It is either general or specific. It is either general or what? It is either general or what? Oh. Is that your perspective? Okay. Inflation is either general or what? Specific. So when we say general inflation, look at these things here. If they are general inflation, price of everything will rise. So you see revenue. The examiner will tell you that revenue, due to inflation, revenue or the price, the item, for you to compute revenue, they will not even give you revenue. They may tell you that this company is producing so items. In year 1, they will produce 15,000 units. Year 2, they produce 20,000 units. In year 3, they will produce 25. In year 4, they will produce 25. Fine. In year 1, the price per unit is this. Year 2, price per unit is this. Year 3, price per unit is this. And year 4, price per unit is this. If they sell those units, what you will get is what? Revenue. Are you getting me? So you will determine revenue. So they may tell you, due to inflation in the economy, prices will rise by 5% on an annual basis. You see inflation rise. Due to this inflation, the cost of materials and others that constitute variable costs will rise by so. Fixed costs will rise by so annually. They will tell you all of this. So they will generally give you the impression that everything is what? Increasing. Then they will tell you specifically that the inflation rate in the economy or the inflation rate is so percent. And you see it affect everything. It is what? General what? Inflation. But there can also be specific inflation. Maybe everything is normal, but because maybe you are dealing in a particular sector, let's say agricultural sector, and because of, let's say, droughts in the north, food is scarce, agricultural production is low. So the price of only food items is what? High. That is what? Specific. Are you getting me? You may see, because of a particular scenario, the price of one thing. The tomatoes, there was a time tomatoes was scarce. People were now using, cucumber or whatever. They do this, they do that, they use it to make their own whatever to eat. Are you getting me? That is what? Specific. So they can tell you that, variable cost alone, or the material alone, that is what? Specific. So specific will affect one or two specific items on this net cash flow schedule, while general will be general. Is that okay? Under specific, they may not necessarily give you an inflation rate in the economy. But if they're general, they will give you that the inflation rate is this. Now, why are we saying this? We are saying this because an examiner or your examiner may give you a situation where he will give you an inflated, I'll explain what it means, an inflated cash flow and give you a real discount factor, or he may give you a real cash flow and give you an inflated discount factor. These are combinations that cannot work. These are what? Combinations that cannot work. The combinations that can work are real cash flow and real discount factor. Then you have the inflated cash flow and inflated discount factor. So for you to discount, the nature of your cash flow must reflect the nature of your discount factor. But the examiner can give you mixed. So if he gives you mixed, how can you work your way to this? By the way, when we say inflated cash flow or inflated discount factor, the typical technical term is nominal. Nominal, are you getting me? So when we say inflated cash flow, we are saying nominal what? Cash flow. When we say inflated discount factor, we are saying nominal what? Discount factor. Are you getting me? Are you getting me? Correct. What do we mean by nominal? Nominal means the naira value, the face value. So if, of course, I go always talk, and maybe this video will get to one person of authority one day. My father was retired 2010. 20 what? 10. He never taking gratuity now as I dey talk to you. So let's say government come consider and come say, okay, well, since, and let's say in gratuity, let me just say it's 1 million. Government come consider and come say, okay, since na 2010 and we no pay you since then, make a condition and make we pay you 1.5 million. Shey 1.5 million is higher than 1 million. Is that okay? But the real value of that 1.5 million compared to 2010 could be as poor as maybe 200,000. Are you getting me? So while they have increased to 1.5 million, let's say I'm saying that the value of 1.5 million, the real value of 1.5 million could be as poor as what? 200,000. Originally they were supposed to pay him 1 million, but they said we have increased it, they've inflated it towards 1.5 million. 1.5 million is just the naira they are giving to him. If that 1.5 million was to be spent in 2010, what it would have got for, what 200,000 would have got for him in 2010 is what the 1.5 million will get for him now. So in terms of amounts, in terms of money, they are giving him more money. That is the nominal what? Value, not purchasing power. So nominal value has nothing to do with purchasing power. It is not even value. Looking at value in the context of, or in the true sense of what value means or connotes, it is not value, it's just money. Relative to 2010, what they gave him is what? 200,000. But this is the naira value. That's typically what government does. Let me tell you a secret. Labour negotiated 2 or 3 years ago with the government because of fuel price increase and inflation. They said increase our salary. Government said, okay, if that happens, we will further increase the price of fuel. Then we'll give you 70,000 naira. They have given labor more naira, but they have given labor less value. So what they gave them is the nominal what? Value, not the real value. The real value is computed or ascertained when you know what money can buy. It's when you know the real value. Are you getting me? When you to know the real value is what they call purchasing power. What can it buy? Before 30,000 naira can buy us 3 bags of rice. Now 70,000 naira cannot even get us a bag of what? Rice. So you have more money, but you've got less what? Value. When I got my job here, USD was like 100 and about 110, 120 USD to a dollar. Then my salary here could be converted to, in fact, whenever I get paid, I just convert them to USD. It's like between 900 to 1,000 USD. 900 to 1,000 USD. My salary has tripled here. But if you compare it with USD now, can it give me 200 USD? I've not thought about that. Are you getting what I'm saying? My salary then, a bag of rice was between, Nigerian rice was between 6,500 and 7,000. I remember when the president or chairman of African Development Bank, this I can't forget, God, he was then the Minister of Agriculture in Nigeria. He addressed he addressed the gathering where he was made the Nigerian rice to them, and he said the price of this rice in the market is 8,000. Everybody shouted. Like, the price of this bag is very, very what? Expensive. They shouted 8,000 naira. So my salary then could get me, say, 8. So it could get me like 12, 13 bags of rice. Now, it can barely get me good 6 or 7 bags of what? Rice. So that is the real value and the what? Nominal value being what? Compared. Are you getting me? So we are saying that you should have the real cash flow, real discount factor, and nominal cash flow and nominal what? Discount factor. In doing this, because they can be mismatched and you now match. To match from a mismatch, you apply what we call the Fisher equation. You apply what we call what? Fisher. Just normal Fisher, the way you know Fisher. Is that okay? Now, the Fisher equation is saying that, let's assume 3 things. We have real, as we have said, nominal, and we have inflation. All of these are in rates, real rates, nominal rates, and inflation what? Rate. Let's assume real is R, the real rate is R. Nominal is what? N. And inflation is what? I. I'm taking I as inflation rates. As what? Inflation rates. Fisher is saying that the nominal N plus, okay, let me take 1 plus N. 1 plus N is equal to 1 plus R multiplied by 1 plus I. 1 plus N equal to 1 plus R multiplied by 1 plus what? I. Now, he's saying that this is the relationship. So if you want nominal, all you do is move this one to the other side. If you want the real, what you do is move this first to this side, whatever you will do to move this to this side. When you are done, you move the 1 to this side so that R can stand on its own. So what you are saying is, if you want to know the nominal, assuming they give you nominal cash flow and real cash flow, nominal cash flow and real discount factor. You will want to convert the discount factor to what? Nominal. So that you have nominal cash flow and real what? Cash flow. Are you getting me? For you to do that, you will have to make n the subject of the formula and find nominal discount factor. This will help you get the discount factor move between real and what? Nominal. Are you getting me? Let's take an example. It's in that material. I don't know the page because what you have is different from what I have. By the way, you guys know that I've started migrating you. Today there will be FR. The FR will work without migrated. If you are my own student and you have not been migrated, let me know. They know. Show you. Okay, you have not been migrated. I've not been seeing you now. So I will migrate you automatically. Yours is automatic. But you guys know now, right? So, but the materials are still very much what we have used. There will be FRO today. And so, everything I've explained is in that material. Everything I've explained is in that material. So let's take an example. You see Baby Boy PLC. Baby Boy PLC. Baby Boy PLC. Page 15. In your material, I think it's page 15. Please, let's be fast. You have it now, don't you? It's that same material now, you know, for our FM material. Please. Somebody should read it, please. Someone should read it. Oh. Yes. So anybody wey dey watch how dem go use get this material? Well, if people dey watch, make dem reach me via my phone number, put them for WhatsApp group and get these materials to them. So if you dey watch, 006-493-2808. So do that and you have whatever material it is. Baby Boy PLC is considering, someone should read.
Baby Boy PLC is considering an investment.
Maybe I should give you this mic.
Machinery, 40,000. Annual sales, 20,000. Annual variable cost, 8,000. And trade in scrap value, 12,000.
Okay, trading or scrap value. They can say trade in.
Trading or scrap value, 12,000. All the cash flow above are in current terms. The real cost of capital is 8% and general inflation is 4%. You are required to ascertain the NPV of the project using the real and the nominal cash flow in the project if the project will last for 4 years.
First, what does the examiner mean by all these cash flows and current terms?
Current terms.
They are all in real terms, in present terms. That's the present value. Present value is the real value of something. Present value is the real value of something. So they are seen as though they are all in year. They are looked at it from year zero's perspective. We are looking at all these prices from the eyes of what?
Year zero.
Are we there? So they are uninflated. They are what? Real. The cash flows are real. Now look at it. Baby Boy PLC is considering an investment with the following cash flows. Machinery 40,000. Annual sales 20,000. Annual variable cost 8,000. And trading scrap value is what? 12,000. All the cash flows above are in current terms. The real cost of capital is what?
8%.
The what? The what?
Real cost of capital.
Even if the man did not tell you real cost of capital, he told you the cost of capital, and he now told you that this is an inflation rate. You should know that the one that was given to you is what? Is what? Real. Are you getting me? Because conventionally, cash flows should be what? Discount factor should be what? In real, except you are told that they are inflated. But this is just for emphasis. So the real cost of capital is what? 8%. And general inflation is what? 4%. You are required to ascertain the NPV of the project using both what? Real and nominal what? Cash flows. I will do the real cash, I will do the nominal cash flow. You people will do the real and I'll watch. Is that okay? You people will do the what?
The real.
And I'll what? Watch. I'll just check what you guys have done. Now, the examiner is telling me that I should use cash flows that are what? Inflated. And I should also use, if I'm using cash flows that are inflated, I should use discount factor that is what? Also what? Inflated. Because real, nominal. What the examiner is telling me is that first, I should use nominal what? Cash flows. That means I should also use nominal what? Discount factors. Are you getting me? I'll do that one. Then you people will do real what? Cash flows. And real what? Correct. So, the good thing is that this examiner is not telling us to get our net cash flows through this. No tax. We are assuming, in fact, there is no tax. It will not give us tax rate, so we can't assume our own tax rate. Okay, so we have Baby Boy PLC. Net cash flow. I'm using nominal. Please, I want to see your calculators on your chairs. Thank you. See, some of you are even older than me, but I want you to understand that my interest is your success. My interest is your success. So if I say you should come with calculators, please come with calculators and not anything that has calculator in them. Come with calculators. And if I say press, please press it. I beg. Because at the end of the day, what I want is for people to pass in my center so that others can know that this center is doing well. And I won't want the situation where you come to this center and you will not do the kind of things you should do, and at the end of the day, results goes the other way, and the impression will be like the center not do well. So please, yes, we have 0. We have 1. We have 2. And we have 3. The first item is what? Revenue. They've given us the revenue already. Nothing in your words. 0. Now, but they said annual revenue is what? 20,000, right? But let's look at it from year 0's eye. They are saying that 20,000 in year 0, we never start business. We are thinking that we have projected the sales we will make, the quantity. We have also projected the price we will sell it for. Is that okay? And based on our own projection, we know that in year 1, we should make sales of what? 20,000. In year 2, we should make sales of what? 20,000. In year 3, we should make sales of what? 20,000. How many years? In year 4, we should make sales of what? 20,000. From year 0, we did not look at it from the fact that, oh, prices may rise. Oh. Are you getting me? But if things are the way they are currently, we will sell 20. Before I started this thing, I made a projection. My projection was year 1, we can have like 15 students. We will make a loss. Second year, we'll have like 22 or 20. We will break even. We will begin to stabilize from, first diet, like 15 students. Second diet, first diet, we make a loss, 15 students. We giving our fixed costs, our variable costs, we make a loss. Second diet will begin to stabilize. Third will begin to stabilize and all of that. Then from maybe the 6th diet, we start making profit. That's my own projection. Now that is assuming price don't what? Rise. Are you getting me? But when you get to that year, you realize that prices have what? Risen. Are you getting me? So there will be what? Inflation. Now, we intended to make revenue of 20,000, but by the time we got to year 1, prices have increased by what? 4%. So the cash flow we expect to have will also rise by what? 4%. So the revenue increases by 4%. That is compounding. Compounding. So what you are doing is 20,000 times 1.04. Press your calculators. 20,000 times 1.04. So year 1 we have 20,800. In year 2, prices will rise again by another 4%. So this one will increase by another. So press what you have on your calculator times 1.04.
21,632.
21,6 what? Times another 1.04.
22,497.
49 what?
7.
Times another 1.04.
23,397.
397. This is our revenue because of inflation. We expected that in year 1, our variable cost will be what? In year 1, our variable cost will be what?
8,000.
8,000, right? Correct. But that is before we consider the possibility of inflation. Now there is inflation. We got to when we are supposed to spend 8,000. We saw that 8,000 cannot get for the things we wanted to get with 8,000. We need more money. And we have ended up spending more money. And that money increased by what? 4%. Oh no, is it 4%?
Yes.
So, yes, so let's go 4%. Variable cost is what? Please, when it's time to press calculator, press your calculator. It's not like I don't give you time to write. The issue of one person giving me figures will expose us to errors. Next year.
8653.
Next year.
899.
Next year. 8359.
9359.
This is cost. So in brackets. Are you getting me? Next, did they say anything about fixed cost? No fixed cost. What else did they talk about? So you know what? Just what happened for transform. Just those three. No, for that, Then ask of the chairman of the estate secretary, ask of the vice chairman. Both of them are not of them. So no fixed cost, right? So let's go scrap value. Ordinarily, having arrived there, in fact, let me do it well. You get net sales. Let's go with the structure. So this is 0. This minus this is what? Please.
12,480.
Year 1, year 2, year 3, year 4. Let's go. Year 1.
12,480. Year 4. 1,408.
1,4,038.
Year 2. 12,980.
980.
Year 3. 13,498.
34,980. Please, let it be known from now, if we have year 1 to 4, do it that way. If we have year 1 to 5, year 1, year 2, year 3, year 4, year 5. If we have year what? 1 to 5, year 1, anything addition or subtraction, year 1, year 2, year 3, year 4, year 5. So let's go. Next is scrap value. Am I right? No, not scrap value. First, initial outlay. No be layout. If they sell land or if they do estate business. No, but if they do estate business. Oh God. So how much is the initial outlay? Now, this is 40 because it is year 0. In year 0, there is no inflation. Are you getting me? There can't be inflation in this year. 1 naira now is 1 naira now. 1 naira, are you getting me? 1 naira now is 1 naira now. It is time that will bring about inflation or time that will lead to reduction in value. So it is what? 40. Next is what? Scrap value. Scrap value has also inflated. Remember, I told you that I bought my car for 850 or thereabout. Going by how inflation should be, I bought that car year 2020, 21, 22, 23, 24. The car should have been completely scrapped. Yes.
Year 2 is 12,979. 12,979.
79 point what?
No, 12,979.
So going by the depreciation rate, that my car would have been what? Scrapped out. But because of inflation, now inflation, exchange rate related inflation, Tinubunomics kind of inflation, if you want to buy that car now, you will buy them at a price that is even higher than what I initially bought it for. So every year, the scrap value they increase. The value of that scrap from year 0 you felt to sell it for, how much is it? 12,000. Is that okay? But now 12,000 year 0. In year 1 it has increased by 4%. In year 2 it has increased by another 4%. In year 3 it has increased by another 4%. In year 4 it has increased by 4%. If you want to know the factor, it is 1.04 raised to the power of 4. Whatever you have times 12,000. This is, I told you, compounding factor. First day I talked to you about compounding. This is compounding. This is discounting. 1.04 raised to the power of minus what? 4. This is discounting. This is compounding. N to the power of n. So if you do this multiplied by 12,000, you will get exactly the same value. But if you want to take it gradually, what you will do is get 12,000 increase it by what? 4%. 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 You will still get the same what? Amount. Are we there? You can do anything wey you want. Kirikeni, that's wrong. I'm not going to hear you finish.
Multiply 12.
1403.
One, know that it can be lower than. If it's lower than, then you are discounting. No?
14,038.
For your mind, they look this one, so maybe you know correct. What is the what you get?
It can be.
Why it can't it be? It has to be higher than number one. It can't be lower than, because it is not discounting. It is what? Compounding. Compound interest. Something is adding. That is what I said. It must be adding. You are discounting. That's why you are giving me 10,000 something. I know we use one person math to judge the math. 14,038. If you know wetin they do, nobody confused. Me, I go confuse you. After all, I can go confuse you. So have 12,000. Are we there? Times 1.04. 1 times 1.04. 2 times 1.04. 3 times 1.04. 4. That is 1.04 into how many power? 1.04 times 1.04 times 1.04 times 1.04. 1.04 into 4 places to 4th power. 2 times 2. 2 times 2 is equal to 2 to power what? 2. 3 times 3 times 3. So 3, this is 3 into how many places? 2. 9. So that's what we are doing. So I want you people to do this one first. Do 1.04 into power 4. 1.04 to power 4. The thing is that people are not pressing calculators. 1.169. Now times 12,000. You got what? 10. What did you press? You did 1.04 minus 4. Where is minus here?
That one discount.
This guy don't bring my this thing. Oh. This did not be charged. I need to bring my inverter. Ew, Kirikeni. You don't be, I don't be. Huh? Nothing come out. Except say na breeze on I want. If say na my other camera for sake it may help. Ah.
Nobody's working now.
It's okay. Let them stay their life.
Okay. Mm-hmm. Talk.
Okay. Using that compound, we have 14.
Mm-hmm.
Then you start it now.
Are we discounting?
No, I'm not asking.
Talk.
Because if you get that house, now you use this one now. This 1.04.
Talk. If you do what?
So as we use that one, because that one just claim that the total value we will give you this one, this 14.
Why would you use that one? Would you use it just because you feel like using it?
So indirectly this one.
Why are we doing this?
It's because of the involvement of the inflation.
What will inflation do?
Inflation reduces the value of.
If we reduce the value, fine. That is the real value. But what will inflation do to amounts in your hand? So we are saying that because of inflation, this man, instead of selling this thing for 12,000, he will sell it for how much? 14. Although the real value will still be 12,000. Although the real value will still be what? By implication, what he should be able to get with 12,000 in year 4, he will get that same thing when now with 12,000. So if it's from today's eye, it is 12,000. If it is from the eyes of 4 years from now, it is what? 14,038.
Someone is asking, when do we know discount?
How? If you want to know the present value of something, you do what? If you want to know the future value, the full value of something, you do what? I've told you you were in my first class. Very, 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 very first class. Please, if you don't know these things, go my videos, go watch them on YouTube. The videos no clear. They are not professional, but you get substance from it. In fact, me, I know they use technical terms because this is our net cash flow now. Because my driver, waiting they spur me on and say make it be say first understand before you know the technicalities. So we have 12,480, 12,979, 13,498, 28,076. Now we discount those that we are doing discounting now. This is the time to what? Discount. The question is, now that we have inflated cash flows, these are inflated, am I right?
Yes.
We have 8%, and they said that 8%, it is what? It is what? It is what? Real. We cannot use 8% because 8% as discount factor is what? Real. But our cash flow is what? Nominal. So they say we should move pair nominal to nominal, real to what? Real. So we have to move our discount factor to what? To what?
Nominal.
To nominal. And to move it to nominal, what do we use? Fisher what? Equation. And Fisher equation is saying that Fisher equation is saying that 1 plus nominal is equal to 1 plus real multiplied by 1 plus what? Inflation rate. And in this question, nominal we don't know. Am I right? Am I right?
Yes.
Real is what?
Real is 8%.
8%, which is 0.08. Inflation is what?
4%.
Which is 0.04. If that is it, we have 1 plus n equal to 1 plus 0.08 multiplied by 1 plus 0.04. Am I right?
Yes.
Am I right? So we have 1 plus n equal to 1.08 multiplied by 1.04. Am I right? Am I right? This will be 1 plus n equal to, this is what? One point what?
1, 2, 3, 2.
1, 2, 3, 2. 1, 2, 3, 2. Therefore, our n will be equal to 1.1232. This moving again minus what? 1. So our n is what?
0.1232.
So our n is equal to 12.32%. 12.32%. Some people will just say they're on smart pass. I can. So instead of going through this, they will just inflation plus real 12%. Now lie. You must show them. Even if you want to assume that you want to use 12%, show them. You must do the computation. If you look at where now, it's 8 plus 4, 12. Am I right? So 12. No. You must do the what? Computation. Fisher. You must be a fisher. So me, I will use that because my calculator. Now, if you are using table in exam, you may not be able to get the table discount factor of 12.32. That is the truth. Table will give you 1, 2, 3. Table will not give you anything like point something discount factor. Are you getting me? But with calculator we can. So I'll say let's use the calculator on as it is. 12.32. I'll use the 12.32%. Discount factor 12.32%. So since it's 12.32%, we are doing what? 1 equal to divide by 1.123 what? 2 equal to. You know what we do? You know what I mean?
Yes, sir.
So you do it for year 1, you give me year 2. You don't know what you are doing. You do. Okay. 0.8900. Just press equal to again.
0.7992.
90 what?
926. So by approximation 9.
Next.
0.706.
Next.
0.628. Yes.
Let's go. We have 40,000. You want what?
11.
Year 4. 17.6.
How did I tell you people to be doing this thing?
It's 1, 2, 3,
For you what?
Year 2.
1 what?
0,
Year 3. 952. 9530.
953.
If we're approximating, it's 9529.5.
4.
Year
Year 4 is what?
is not on.
No, we are year 3.
No. Year 1, year 2, year 3.
Maureen, year 4 is what?
No.
Year 1, year 2, year 3.
17.
One. Both of the last.
So let's go. This is our PVs. These are our PVs. So our NPV will be equal to, add this present value of cash inflows, present value of cash inflows minus present value of cash outflows. That will be equal to PV of cash inflows. All of you. Oh God. Minus 40,000, and that is
8561.
8561. This is our. Now, what I want you to do is this. Listen, oh. What I want you guys to do is this. You guys will do exactly the same thing, but use real what? Cash flows, and real what? Discount factors. Meaning you are not doing this.
Yeah.
The real discount factor is given to you as what? 8%. The real cash flows are already given to you. So just set them as they are and discount them. Let me see your discounting ability. If you want to, if on your own you feel there's any adjustment to make, you make it. Are we there? You are not here. So that's it. So do that, and that's all about inflation under this.